Hey everyone, welcome to another video by Optionables. My name is Saket, and in this video we are going to discuss about why exactly the markets are going to hit all-time high part 2. So we have already made the first part to this and I'll be attaching the link in the description in case if you haven't watched that. So I recommend you to watch that first and later continue with this video. So in the last video we had discussed about the interest rate cycle, how exactly interest rate works and how exactly interest rates affect the economy. So in this video, we are going to continue with the market cycles. Now we are going to see how exactly the market reacts to the economic cycle. So the thing is, you might have heard that people always say market is a forward-looking instrument. So it always prices in the future and not the past. So if some data is coming out today, it is mostly going to be the past data. Let's say I report a GDP number today, it would be the GDP number of the last 3 months and it has nothing to do with the future. So market is always set to price in the future and not the past. So that's the reason if market is reflecting the price today, then that is going to be the economic scenario sometime in the future. So this might sound confusing. Let's try to break this down and understand this much better. Before we continue, I would like to tell you this particular thing. It is generally believed that the markets bottom out within the 1/3 of the completion of the cycle. So what do I actually mean? In the last video, we had discussed about the interest rate cycle. So right now, US is increasing the interest rate to bring down the inflation. So if the interest rate keeps on going up, that is going to slow down the economy. And if the economy slows down, then the inflation is going to come down. But it is also going to hamper the growth rate of the economy. And theoretically, market should not perform well if the growth rate is low. Or in case if we go into recession where we are going to have negative growth rate, even then the market is not expected to rally, or forget about rallying. If the economy is actually going down, you expect the market to go down. Forget about rally happening. Then if we go by the theory, Fed is expected to increase the interest rate in the upcoming quarter, mostly by 50 basis point, and later again further expected to increase by another 50 basis point moving ahead in the next quarter, and maybe later by 25 and 25. So they are projecting that Fed might increase the interest rate all the way up to 5.5 to 6%. So that means you expect the markets to keep on falling for the next almost around 9 to 12 months. That is not going to happen. And here is exactly why that is not going to happen. So here I am going to give you some examples from the past to make you understand why market will not keep on crashing for the next 6 to 8 months. Rather, we can hit an all-time high. So now let's go back to the situation of COVID. So we got COVID in March 2020. Right after the case came to India, immediately the markets fell 35%. This was also the time when our Prime Minister announced the lockdown. So technically, going by the theory, we should have experienced a downfall in the market throughout 2020 and 21 because the economy only came back to the top in 2022. So during 2020-21 and up until 2022, the economy was actually in a downturn. But the thing is, right after the lockdown was announced and COVID cases came to India, the market fell 35% and also bottomed out in April itself. Whereas the real impact of COVID was felt post-April. So when did we actually see a COVID hitting the economy? It was in the quarter of April, May, June. The worst hit quarter was July, August, September, where the economy crashed close to around 29%. But the surprising fact that when the bad news started flowing in, the market actually started heading higher and higher. The thing is, it is always known that the markets bottom out during the 1/3 of the cycle itself. A similar example can be seen even during the Russia-Ukraine war. Right after the war started, the markets fell almost close to 10 to 15%. But the thing is, Russia-Ukraine war is continuing for the past 6 months, but still market continues to go higher. Why? Because markets usually price in the event well before the event impact is actually seen. Now actually if you look at November 2020, when the vaccination started coming out and US elections happened, we hit an all-time high where the economy was almost at the worst point. We hit an all-time high. Why exactly did that happen? Because the market was pricing in the future and whatever we knew was based on the data we had today and it was not on the future estimate or the future projection of the data. In March, market crashed 35%, pricing in the entire impact of COVID. Otherwise, you tell me, why exactly will the market crash 35% in March when the economic impact is not seen at all? So was there any economic impact in March? Absolutely nothing, whereas the market crashed 35%. So the market has already priced in the entire impact of COVID in the month of March itself. That means once the entire impact is priced in, so slowly it is going to recover and start going higher. So similarly, we saw during the Russia-Ukraine war. So the day war started, from that day the market fell almost around 10% in a week, and slowly it started coming up. Why? Because it priced the entire impact of the war just within a week. And not just that, when we started to see interest rate hike, the entire interest rate hike is already expected to be priced in by the market, because we got to see that in the last two Fed rate hikes, even though the Fed rate was hiked by 75 basis points, the market started reacting positively. So this just shows that the market might have already priced in the entire interest rate cycle impact. So this is just a speculation, because based on the past data, it is believed that the entire interest rate cycle is already priced in, and even if the interest rate goes to 5.5%, the market is not going to crash from here. And not just that, we also get to hear many people talk about a recession coming, job losses happening, and the markets will fall and all of those. So coming to this point, it is already expected these things will happen. So it is not a surprise for the market. It is already expected that these things are the impact of interest rate hike, and these things are the impact of the economy slowing down. So these are not surprises which we are getting to see in the market. This is just the impact of the decision of increasing the interest rate. So we can conclude that the entire interest rate hike impact has already been priced in the markets. So even if we get to see any GDP data where it has slowed down, or even if we get to see any jobs data where there has been massive job losses, the market is not going to crash, because the whole thing has been priced in. So this is always a cycle, and it keeps on repeating. So I am also going to give you one more example where we actually topped. So this was somewhere around 2018 and 19, where India reported the highest quarterly growth in GDP, somewhere around 8.1%. And trust me, that was the top of the market. So from there on, the market almost crashed close to 12%. So why exactly this happened? The thing is, even though we got a GDP growth of 8.1%, which was the highest GDP growth, the market was pricing in the future and not the past. So that 8.1% number was something from the past and not something from the future. So not just this, you can go back to history and take any event. For example, demonetization. The moment demonetization was announced, the markets crashed 5 to 6%. So that was the total impact that was expected on the market, and slowly it started recovering. Even if you go back to 2009, the actual recovery happened somewhere around 2012 or 13, but the markets had bottomed out well before 2010 itself. So we get to see this scenario repeat multiple times, and since market is a forward-looking instrument, it is always going to price in the future and not something from the past. So impacts are always priced in during the first drop itself, and the thing is, we only get to see the impact after the event happens, and as we give it time, slowly one by one impact starts to come out. But the market would have priced all this in the first initial drop itself. Even during the COVID, we got to see that the second wave and the third wave came much later than April, where the markets had already bottomed out. So even though when these waves came, the market actually headed higher. So this is another example why market always price in the impact of an event well before the impact is actually seen to our eyes. So now the question obviously would be, why exactly am I telling Indian markets might hit an all-time high? So we had made the last video, the first part of this video 2 weeks back, and I was already expecting the markets might hit all-time high before we make the second part. But luckily they still haven't hit all-time high, so they retested 18,400 and they came down. But now I'm going to give you reasons why exactly it won't be a surprise if the market hits all-time high before December end. The thing is, let us try to understand the entire world. So in one place we have the US economy, which is growing somewhere around 1.5–2%, and the inflation rate is close to around 7.5–8%. Next, we will consider the European economy. So when we consider the European economy, so there the growth rate is just around 0.5%, and most of the European economies have negative growth rate. That means they are growing at -0.5 to -1%. Whereas the inflation is almost close to 9 to 10%. So there the economic condition is much worse than US. Now let's come to Asia. In Asia, Japan, China and India are the major economies. So now if we take Japan, so Japan is no better. The economic growth rate is extremely slow. Inflation is under control, but again the growth rate is very slow. If you actually look at it, from 1990, Japan market has not performed well at all. So the high which it made in 1990, it has still not reached even today. So if you look at the China market is doing relatively better. But the foreign institutions are slightly hesitant to put their money in China market because China is not very transparent. And again, we also know the rift which is happening between US and China. So obviously US institutions would slightly avoid putting their money totally into China. Next, coming to our neighbors, Pakistan, Bangladesh and Sri Lanka, we all know that these countries are going through an economic crisis. And finally, if you come to Taiwan, there the political stability is not really good. That means what is the next option they have? That is only India. So when we come to India, we know that the growth rate is somewhere around 6.5–7%, and the inflation is also close to around 5.5–6%. So this is perfect recipe of growth where the growth rate is much higher than the inflation rate. So the thing is, we know that the foreign institutions have pulled out close to around 2.5 lakh crore from our market last year. And our market was mainly supported because of the domestic institutions. It is not just from India where they have pulled out across the world. So they have pulled out their money from other economies in Asia, they have pulled out their money from other economies in Europe. That means next, when the interest rate slowly starts to come down, so this cycle is expected to end by mid or end of 2023, and from 2024 we are expected to slowly see the interest rates come down as the inflation comes to control. Once that starts to happen, we must see the money which was pulled out by these institutions come back to the economies. I already told you the global scenario, what is the growth rate of each economy and what is the inflation rate of each of the economy. Given this particular number, it is mostly seen that the most of the money would actually return to India rather than any other economy. People who had invested in Europe in the past would most likely invest their money now in India. Similarly, when you compare to other Asian economies like Sri Lanka, Pakistan or Bangladesh, so the institutions which had invested in these economies will most likely now invest in India. Why? Because India is right now the fastest growing developing economy. When I keep saying markets and markets every time, obviously your question would be, who are these markets or what exactly is this market? The market I'm talking about here is nothing but the smart money. So the thing is, when you look at big institutions, so let's just take an example of Berkshire Hathaway. When the markets was actually heading higher in 2019 and 20, Berkshire Hathaway had cash worth of $145 billion. So this was the total cash pile they had, which they hadn't invested. So once the COVID crash actually happened, they started putting in a lot of money. So this is just example of one institution which actually built up its cash pile while the market was going higher and invested heavily when the market came down. So this is nothing but the smart money where hundreds of billions of dollars get invested or pulled out at a point in time when the market either starts going up or coming down. So based on this particular economic scenario, we believe that we are not very far from hitting the all-time high. It might just be a matter of time before we actually cross 18,500 and head towards 19,000. Because once the economy starts to come out of this recession what we are talking about, we are going to be headed for a very long and good quarter of growth. So that's why it is always important to invest for the long run and not really bother about the short-term fluctuations. So the thing is, as we already mentioned, that once the event actually occurs, the impact is seen over the next few quarters, whereas the market prices it in the same quarter. So if the event is occurring now, the market falls immediately, whereas the impact will be seen post 1 or 2 quarters, and we shouldn't be really worrying about the news which comes 1 or 2 quarters later on. And if you have invested for the longer run, so then do not worry about the portfolio, do not worry about the coming recession that is already priced in the market. So with this, we also come to the end of this video. If you have found this video informative, do not forget to hit the like button, share this video, and also subscribe to Optionables. Thank you so much for joining.